America didn't just stumble into a $10 trillion financial gap. It wasn't an accident. And it definitely wasn't just normal inflation. What if the real reason your rent exploded, your groceries doubled, and your paycheck suddenly lost its power is because the Federal Reserve opened a backdoor pipeline? A pipeline that funneled trillions of US dollars into foreign banks, private institutions, and shadow market players you've never even voted for. And what if that loophole is still running, right now, as we speak? Tonight, we're pulling back the curtain on the most secretive money transfer system in modern American history. It's a system designed not for you, but for a global elite who treat the US dollar like their personal oxygen supply. But before we dive deeper, I have a quick check-in for you. Where are you watching from? Drop your city in the comments below. I want to see just how wide awake this community really is. And if you're here for the unfiltered truth, the kind of information that no mainstream outlet would ever dare to touch, then hit that subscribe button. Because after this video, the world is going to look very different. Now, let's go back to where this all began. It's a history that sounds disturbingly familiar, a mistake we've already repeated, and a secret the Fed never thought the public would connect to today's $10 trillion gap. To truly understand the crisis we're in today, we need to return to the moment America realized something terrifying. The entire world runs on dollars, even when the world doesn't have enough of them. This was never the plan. It wasn't in the Constitution. It wasn't even sound economics. It was a panic response. The roots of this go all the way back to 1944, to a conference in Bretton Woods. The US promised the world stability, gold, and the strongest currency on earth. But underneath that shiny surface, a pressure cooker was forming. By the late 1960s, foreign governments and banks held so many US dollars that America couldn't actually redeem them all for gold anymore. The math just stopped working. France started calling out the US publicly. Other nations lined up right behind them, and behind the scenes, the US quietly started to panic. When President Nixon closed the gold window in 1971, everyone celebrated it as economic freedom, but here's the twist nobody talks about. Closing the gold standard didn't solve the dollar shortage. It amplified it. The world now needed even more dollars to trade for oil, commodities, and debt. But America couldn't just print that many dollars fast enough without completely destroying its own economy. So, a new solution was born. Not in Congress, not in the Constitution, not in any public debate, but in the shadows. Foreign banks found a loophole. They discovered they could create offshore dollars. They called them Eurodollars and operate completely outside of US regulations. No oversight, no limits, no voter control whatsoever. Sound familiar? Whenever a system becomes too big to regulate, it becomes far too easy to exploit. By the 1980s, this offshore dollar world had grown so enormous that the Federal Reserve faced an uncomfortable truth. Foreign banks now held massive amounts of US dollar liabilities, but they had no obligation to follow US rules. If those banks collapsed, the entire global financial system would collapse right along with them. Sound familiar? This was the first moment the Fed quietly admitted to itself, we may need to backstop banks that we do not control. Now let's fast forward to the 2008 financial crisis. Foreign banks were drowning in toxic derivatives tied to American mortgages. They didn't have enough dollars to stay afloat, and the world suddenly realized something explosive. The Federal Reserve was the only entity on the planet capable of printing the global emergency currency. So, behind closed doors, an emergency mechanism was activated. It wasn't debated. It wasn't voted on. It wasn't even mentioned in most economics textbooks. It was called the Central Bank Liquidity Swap Line. Think of it as a direct pipeline, connecting the Federal Reserve to foreign central banks, allowing them to borrow unlimited US dollars in exchange for their own currency as collateral. Most Americans never even heard about it. Does that sound familiar? This mechanism completely bypassed Congress. It bypassed the Treasury. It bypassed every single democratic oversight system we have in place. And here's the real shocker. The swap lines were never temporary. They became permanent. During the 2008 crisis, the Fed funneled over $580 billion to foreign banks through this exact loophole. But during the COVID crisis, that number skyrocketed past $4.5 trillion. And yet, the public was told, don't worry, everything is under control. But ask yourself this, if everything was under control, why does America have a $10 trillion financial gap today? Why does inflation feel permanent? Why did foreign banks get unlimited dollars while regular Americans got price hikes? It's because the secret history we ignored is now repeating itself, but with even higher stakes, even bigger numbers, and even more invisible players. And the mechanism at the heart of it all. It's worse than Eurodollars. It's worse than toxic mortgages. It's worse than subprime loans. Because this time, the loophole is automatic. and the institution behind it is so untouchable that even Congress can't see what's happening inside. Here's the real turning point in this story. Most people believe the Fed only controls the US dollar inside the United States. That's the illusion they want you to believe. In reality, the Federal Reserve became the emergency lender for the entire world's dollar system, even though nobody ever voted for it to have that power. But it gets even darker, because the liquidity swaps were only one half of the loophole. The other half: shadow banking derivatives. Here's what the public was never told. Foreign central banks weren't just borrowing US dollars for themselves. They were handing those dollars over to private shadow banks, who then used them to build massive derivative structures. These are contracts that multiplied the risk by 10 times, 50 times, even 100 times. These contracts weren't traded on public exchanges. They weren't monitored. They weren't even listed on the balance sheets. They were invisible, by design. So, a foreign bank could borrow $10 billion in Fed swap line money, hand it over to a shadow institution, and that institution could then build $500 billion worth of hidden financial exposure. And if the system collapsed, the Fed and, by extension, the American public would be the ones to eat the losses. This is the real mechanism behind that missing $10 trillion. It didn't just vanish. It wasn't stolen in a traditional sense. It was multiplied into offshore obligations that Americans were never, ever supposed to know about. It's a system the Fed cannot unwind, a system Congress cannot audit, and a system that continues to feed itself through a loophole that was created in a panic and then weaponized in secret. And the craziest part of all of this: there is a name, an institution, that engineered the modern version of this mechanism. It isn't a bank you've ever heard of. It isn't a government agency. It isn't even the IMF. It's something far more shocking and far more protect exactly who they are, how they built this offshore dollar empire, and the financial weapon they designed that now threatens the entire US economy. You will not believe the name. The receipt is wilder than you could ever imagine. Thanks for watching, and make sure you're subscribed so you don't miss it. Alright, take a deep breath, because this is where the story stops being a theory and becomes a system. Remember the name I said you wouldn't believe. Let's reveal it: the Bank for International Settlements, the BIS, the central bank of central banks. The institution, immune to audits, laws, and national oversight. This is the command center that designed the modern offshore dollar empire. This is where liquidity swaps evolved into a permanent architecture, and this is where shadow banking derivatives were standardized, multiplied, and unleashed. But most Americans don't even know what the BIS is, and that's intentional, because the BIS has one mission: keep the global dollar machine alive at any cost, even if Americans pay the bill. Now let's break down how the $10 trillion loophole actually works. Step 1. The Fed creates dollars, but not for you. When the Federal Reserve prints money for QE or emergency operations, the public imagines those dollars stay inside the US, but that's not true. Behind closed doors, the Fed activates its liquidity swap lines, allowing foreign central banks to borrow unlimited US dollars in exchange for their local currency. This isn't a loan to a country. It's a loan to a central bank, which then decides who gets those dollars. And you know who gets them. Not hospitals, not households, not small businesses. They go straight to the top layer of the global banking pyramid, banks whose names almost never appear in US media. Let's put a number on it. During the 2020 crisis, the Fed funneled over $4.5 trillion in swap dollars to foreign central banks. That's more than the entire US stimulus package combined. But that's only the beginning. Step 2. Foreign banks convert Fed dollars into shadow leverage. Here's the part that's almost unbelievable. A foreign central bank can take $10 billion from the Fed, pass it to private banks under its jurisdiction, and those private banks can build derivatives contracts worth 50 times the original amount. That's $500 billion in exposure, created from just $10 billion in Fed swap liquidity. And because these derivatives are off balance sheet, they don't show up in public reporting. They exist, they grow, they mature, but nobody sees them until they explode. Globally, shadow banking derivatives now exceed $610 trillion in notional value. That's almost 7 times the world's GDP. Where did the fuel come from? Fed swap lines. But there's more. Step 3. The BIS adds the secret ingredient, the netting illusion. The BIS introduced a framework that allows banks to offset their derivative exposure internally. This means if Bank A owes Bank B $100 billion and Bank B owes Bank A $100 billion, the BIS lets them report it as zero exposure. This is the netting illusion. So the public sees zero. In reality, there's $200 billion in gross exposure waiting to detonate if either side defaults. Now, combine that with Fed swap liquidity, and you get this chain. Dollars get leveraged offshore, hidden using BIS rules, and multiplied into global obligations Americans don't even know about. This is parasitic finance at its peak, and it gets worse. Step 4. Eurodollar institutions act as the middlemen. Eurobanks, which are foreign banks operating outside U.S. law, are the actual distribution network. They take the Fed swap dollars, lend them to shadow banks, structure exotic derivatives, and then recycle those contracts back into U.S. markets as foreign investment. It's a circular loop. The Fed prints dollars via swaps. Foreign banks multiply them in the shadows, and then the derivatives re-enter America, disguised as foreign capital, while Americans pay the price through inflation. Here's a number most analysts avoid. Eurodollar liabilities, meaning offshore dollars, now exceed $57 trillion. That's far more than the official U.S. money supply. Let me say that again. More dollars exist outside America than inside it, and none of that is under U.S. control. Step 5. The moral hazard. Global banks know the Fed will save them. This is the most dangerous part. Every foreign bank involved in this system knows the Federal Reserve cannot allow them to collapse, because their collapse would collapse the global dollar. So they take bigger risks. They build bigger leverage. They create more derivatives. They expand their offshore obligations. Because they know that if they fail, the American taxpayer will cover it. This is not economics. This is engineered moral hazard. Let's look at a number from 2008 that still shocks economists. The Fed secretly provided $580 billion to European banks. That's more than it gave to all U.S. banks combined. Not one American voter approved that. Not one American taxpayer was informed. But you felt the consequences through inflation, wage stagnation, and debt. And during the COVID crisis, it happened again, and now, it's happening permanently. Step 6. The infinite loop that explains the missing $10 trillion. This is the heart of it, the mechanism behind the entire thesis of this video. The $10 trillion gap formed like this. Fed swap lines created trillions of offshore dollars, invisible to Congress and the public. Shadow banks leveraged those dollars 50 to 100 times through unregulated derivatives. BIS accounting hid the true exposure using the netting illusion. Those dollars then re-entered America as foreign capital, inflating asset bubbles. Inflation hit us households, while the offshore system avoided consequences. The exposure became too large to reverse. The Fed can't unwind it. Congress can't audit it, and foreign banks depend on it. That is the $10 trillion gap, the portion of the offshore dollar empire that is mathematically unrecoverable. And if you think this is over, global dollar obligations, much of it created through these swaps and derivatives, now exceed $90 trillion. America controls the dollar, but America does not control the dollar system. The offshore world does, and the loophole that empowered them, it's still running, still expanding, still feeding the shadow empire. So here's where this story becomes personal. Not historical, not theoretical, but inevitable. The global dollar machine built on liquidity swaps and shadow bank derivatives is bigger, faster, and more interconnected than ever before. Which means the next collapse won't look like 2008, it won't look like COVID. It will be worse, because the system is now global, not national. Digital, not physical. Leveraged, not collateralized. And instant, not delayed. When the offshore derivative chains start snapping, they will snap everywhere at once. Tokyo, London, Frankfurt, New York, and the Federal Reserve, no matter how powerful, cannot print trust, it cannot print stability, it cannot print accountability. It can only print more dollars, which will flow through the same loophole, into the same shadow network, feeding the same moral hazard. Here's the uncomfortable truth. We're living inside a system running on borrowed time and borrowed dollars, and the institutions designed to protect you are the same institutions that helped build this house of cards. Not because they're evil, but because they're trapped in a machine too big to slow down. So the question you need to ask yourself is simple. Are we wiser now, or just walking the same path in better suits? Before you go, I want you to share your voice. Do you think the Fed should control global liquidity, or only American dollars? Drop your thoughts in the comments. I read every one. And if you want more unfiltered truth, the kind that turns confusion into clarity, hit subscribe right now, because the next chapter of this story is coming. And trust me, you won't want to miss it.